last year. So thank you all for coming. We've got hopefully a couple good presenters for you tonight. We've got Jonathan Guenthner from ELO. I'm going to give you an update on income tax and some related things, and then we've got Vince Potiker coming to give you all the marketing expertise you're going to need for the next year. And we'll wrap up just with some things, just some wrap-up stuff for the year for our program participants. So we are going to record tonight's session for the benefit of those who are unable to attend. So if there's anything that you thought was particularly insightful that you want to share with a spouse or a neighbor or something else, we will get this recorded and put on our website. So we'll send that information out when we get that uploaded. So I will let Jonathan come up and get started here.
Okay. Hi, I'm Jonathan Guenthner. I had told Jared, I was telling my wife yesterday, I was nervous I was going to be speaking in front of tens of people. So that was my joke. It's bad, I know. I'm from ELO. A little bit of background on us. This is really quick. I'm not going to go into it a whole lot. We do a number of items: tax, auditing, accounting services. Our main objective is to provide a quality service and problem-solving expertise in a cost-effective manner. That's what we try and do to all of our clients, for all of our clients. I did include what we call our farm and tax team. This is moving around a little bit, but we're trying to get some people more in a niche type of an area. So this is just some of our people. The one I will mention, Aaron Moeller, sitting in the front row here. He's also from ELO. He wanted to come and see the presentation as well. So this is just my bio, just wanted to give you some information. My email address is there. I know Jared didn't print out the handouts, but if anybody wants one, let me know. I can get you one. I can email it to you. We can print one out, whatever you need.
I jump in here.
Yeah.
I forgot to mention that we've got pizza coming, so he'll kind of wrap up his presentation, and then we'll grab pizza, and then Vince will get started. So pizza is coming. So thank you.
Just a little bit more, just one more thing on myself. I've been with ELO almost 10 years. My specialization is agri-accounting, accounting, tax, just everything agricultural related. I grew up on a farm, and so I can kind of both talk the talk and walk the walk somewhat. Not as good as I used to, but I can. Record keeping, there's a few, just to kind of give you an update on what I kind of planned for this presentation. I have one that's much longer. I scaled it way back. A number of you have probably heard some of the presentations, so I tried to change it up a little bit. Two, Jared told me I had a half an hour and we could talk on one topic for that. So, but anyway, there are a couple of things I did want to mention. Record keeping, good record keeping, which is, I know why you're in the MTI program, is to help with your record keeping. This is just some of the benefits that we see from good record keeping. Looking, monitoring your progress, preparing your financial statements, getting ready for your tax return, which is what a lot of people are concerned about, but also you can find out if you made money in a certain area if you keep good records. If you keep good enough records, you can find out if this crop did well, that crop did well, and that type of concept. So, the next topic I have for you is tax planning, and just a few slides on this, and I'm going to go through this fairly quickly as well. When we look at tax planning, we look at a number of things. The main reason that we look at tax planning is we're planning to wisely and prudently pay what we consider, or you consider, your fair share of taxes. In our office, we don't want you to pay more than what's rightfully owed, but we're also not going to lie, cheat, and steal for you, basically. We're going to look at how we can manage the number, but we view taxes as a part of your operation. It's I hate to say it, but no different than chemical, seed, fertilizer, those types of items. Because if you're paying taxes, you've made money. That's kind of our thought process, is taxes are not always an evil thing. So our objective when we're doing this is trying to reduce the effective rate. That may mean that it may be a big number, but it's the most effective rate for you. Right now, the Social Security limit is $117,000. When you're in that $75,000 to $100,000 range of taxable income, you are paying roughly 43 3, I believe, %. When you buzz through that bubble, it goes down to 3%. You're back at 35 to 38% tax rate. So that's what we're kind of looking at, where maybe taking some income may cost you a little bit more tax, but the effective rate has gone down. So that's what we're looking at with some of that objective. It's all part of perspective. Like I said before, it's a cost of doing business. It's got to be a consideration, but I will say this, and Jared has probably mentioned it, it cannot be the only consideration. Spending $100,000 on a tractor to save 25 cents per dollar in tax doesn't necessarily make sense. Now, if you need it, maybe, but that's part of what we do when we meet with you through the tax planning side of things. We think it should be comprehensive, look at not only the income tax, self-employment tax, estate taxes, any of those types of items. The biggest thing I can tell you is it needs to be done in advance. I cannot give you a good tax plan. Your tax advisor cannot give you a good tax plan if you're meeting with them on December 31st and it's the first time they've seen your numbers. Because you don't have a whole lot of options, and it's going to take more time than a couple of hours probably to figure out what you need to do and to get it done. So that's probably my best part of the tax planning side of it is you got to be a planner. We're starting to do a lot of our tax plans now. We've started first part of November through the middle of December is when we'll do a good chunk of our tax planning. So with that, there are a few strategies. I'm not going to go into this real detail just because of time. You can use timing, you can defer payments, you can prepay expenses, shifting, splitting. Some of that you can do with family relationships. You can pay wages to children. You can do some of that type of stuff to move it from one tax bracket to another. Investing, that one's more like-kind exchange types of things, but how can you reduce your taxes through investments? Most of the time you're looking at an investment not to necessarily reduce taxes and make money, so that's kind of a catch-22, I guess, if you will. And the use of the tax law, which most of you are aware of, is probably the most frustrating part from our end because we don't know what the tax law is. So that's the major strategies. The next few slides, I'm going to go through a couple of things. Some of them I might go through fairly quickly just because it's more of an informational thing. There's really only about 3 major things that I can talk about from updates of tax law because everything else has stayed pretty much the same. The first one is the health insurance individual mandate update. The second one is what they call the repair regulations, and the third one's depreciation. So I've left a little bit of time at the end because I have a feeling the depreciation one will be a good topic. But individual mandate, part of the Obamacare, Affordable Care Act, whatever you want to call it, was starting in 2014, all individuals must have health insurance. If you don't have health insurance, you have to report it on your return, and there are a number of penalties involved. The penalties are somewhat vague, I guess, and also somewhat hard to understand, so I'm not going to go into real detail on it. The major way I can tell you is the penalty is the greater of $95 per adult, capped at 3 adults, or 1% of an individual's household income. So basically, the $95 doesn't matter because $95 is 1% of $9,500, which is not where the filing requirement kind of falls in. If you have less than $10,000 in income, you don't have to file. So it's kind of a moot point, I guess, for lack of a better way to put it, but that's the way it's written. So basically, for everybody, if you don't have health insurance, for each month of the year, there is a little bit of an exemption for loss of coverages and stuff like that. But if you don't have health insurance, the penalty is 1% of your household income, which is basically your adjusted gross income. So let's just say, and I'm going to use a big number just because I can do the math in my head really simple. It's $100,000, 1% of that is $1,000, that's what the penalty is going to be. Now, here's the goofy part. The IRS has no collection authority on this. You can report it and say, I'm not going to pay it. They can't come back at you. They have no lien authority. They have no collection authority. Basically, what they can do is they can withhold a refund if you've got a refund coming, or they can, if you do owe tax, they can apply the tax payments however they feel like it. So they can say, well, you owed, let's just say you owed $10,000. 2 of it was the health insurance, but you said, I'm not going to pay that, so you're only paying 8. They can actually apply the 2 to the 8, and then they can out of the 8, and then they can come back at you out of the other stuff. So That's where they're coming, they can come back at you. The other thing with the health insurance is you can get it through a number of places. You can get it through private insurance, employers, and all that type of stuff. The other place that they do have it, and you've probably heard a lot about it, is the marketplace. There is this, and I've never been to it because I didn't need to, but you can go out to this marketplace, estimate your income, and they'll tell you, well, this is what you can get for this, and this is what you can get for that, and here's what your premiums are, and they have all the different levels. You can apply for exemptions. Some of the ones that I know that are probably the most applicable in this area is if anybody's involved in a religious cost-sharing type of a thing. There's a few different Christian service type things that have health cost-sharing. Those are exempted. The other one is if you're, like, for instance, colonies are exempted. The other way you can get exempted is if it's unaffordable. If it's more than, I believe it's 8%, is that right here? 8% of your 8% of your adjusted gross income, that's considered unaffordable, and then you can get an exemption that way. The only, and I can't remember if I've got 2 slides, that's okay. The only other side of this that I will mention is if you buy the insurance off the marketplace, they have a premium assistance credit that you are actually eligible for when you buy it. You say, this is how much my income is. They'll tell you what the premium is. Well, when they tell you what the premium is, there's actually an advanced tax credit built into that. So let's just say they tell you the premium is $200 a month. Well, the actual cost may have been $500 a month, and there's this $300 credit. Well, when you go to the end of the year, and if your income actually happens to be more than what you said it was on this application, they're going to come back and ask for that credit back. So that's something that people probably need to watch a little bit. Don't kill the messenger on this. But that's what you're probably going to have to watch for a little bit if you were out on the marketplace or did something through the marketplace, because it's something that I feel they've done a poor job of explaining to people and putting out there. I think they did it on purpose this way. I think there's going to be a lot of upset people when at tax time when they go in and their income's less than what, or more than what they thought it was going to be, and now all of a sudden they've got an additional tax due. So it's something that we've kept an eye on. We're keeping track of the actual machinations themselves for the taxes and that type of stuff. We know, we're aware of. I'm not going to present it here because it's maddening. Really is the bottom line. The other side of the health insurance item is, and many of you probably have heard of this, the Section 105 plans. The big one is AgriPlan through TASC. And this works very well. However, I will say this, it only works well, especially now, if you only have one employee. If you're only employing your spouse, is when it works the best. Because if you employ your spouse, it does a couple of things. You pay your spouse, you allow them a tax-free fringe benefit of paying for their health insurance and all of their out-of-pocket medical expenses. That gets to be deducted straight off your Schedule F. So it's deducted for self-employment tax purposes and income tax purposes. And what happens then is you're able to deduct that. They don't have to pick it up as income, so it's a pretty good deduction. However, if you have more than one employee and you don't offer it to these other employees, you've just been in violation of the Affordable Care Act, and I believe the penalty is $100 per employee per day. It becomes very expensive in a hurry. So I will warn you that if you're using that and you've got more than one employee, you probably need to be looking at getting out of it. The other thing you can do, which could also become very expensive, is offer it to the other employees. So that's something that a lot of our smaller businesses and farms are going to have to look at, because this health insurance thing is becoming more and more of a big deal. This is a very nice way to deduct your out-of-pocket medical and your health insurance, because otherwise the health insurance is just a deduction against your total income, and then the out-of-pocket medical becomes an itemized deduction, and most people don't itemize. So it's a nice way to do that. However, be aware, there are going to be penalties involved if the IRS catches wind of it and you're not allowing it to other employees. The next item I'm going to talk about briefly, and this is just more of an FYI, it's something to talk to your preparer about, your accountant about. The technical term is the tangible property regulations. We call them the repair regs. There are a number of items inside of this, but what I wanted to present primarily, what I wanted to bring to your attention was, under these new rules, the IRS is starting to look at repair expenses much closer. What they're doing is a number of things, but what they've done is they've passed a new regulation that's saying pretty much any repair over $500 should be capitalized unless it's exempted. Now this is where things get a little bit hairy because you can't hardly call Scott's and have them come out, or C&D and have them come out before it's $500. They pull in the yard, it's almost $500. So it's something that's becoming a concern for us that we're looking at. We're looking at capitalization policies for clients and some of that type of stuff. What it is they're looking at all of these items and saying, if it's over $500, you should be looking at capitalizing. There are a couple of items that they're looking at that do affect it. Routine maintenance, oil changes, hoses, valves, that type of stuff is exempted because it's on a routine, regular basis type of a thing. Where we're concerned about it is you pull your combine in and have somebody go over it for the year, and all of a sudden it's a $20,000 expense. We need to be looking at whether or not that should be capitalized or whether or not that should be repaired. There's some rules with that. Like I said, the $500 is a de minimis item, and I've got two terms up here that I probably should explain a little bit. I have with AFS and without AFS. AFS stands for applicable financial statements, and 95% of our clientele does not have an applicable financial statement. An applicable financial statement is something that's filed, reported with the SEC. It's audited financial statements required by the bank. Those are probably the two main ones that I can think of off the top of my head. There's one other one, but I can't think of it off the top of my head. But it's those types of items. And if you have a capitalization policy and an applicable financial statement, the de minimis is $5,000. Anything under $5,000, the IRS will not touch you. They won't look at if you have those items. If you don't have those items, or the applicable, what they call the applicable financial statement, the de minimis is $500. So basically what they're saying is, as long as the invoice is under $500 or each item you purchase is under $500, we're not going to look at it. If it's over $500, you may not have an issue, but they may come in and say, well, you need to explain the difference here. So if it's a $5,000 repair, which let's just say it's a tire or something like that, and it ends up being expensive, it's $2,500, $3,000, whatever it is, they're going to come in and they're going to want you to explain, well, why was this a repair, not a capitalizable item? So that's what we've been concerned with. Routine maintenance, like I said, does not need to be capitalized. The definition of routine maintenance in their eyes is something that would not be reasonably expected to be done more than once during its class life of the unit of property. So for instance, all farm equipment, the class life is 10 years. So it's something that you would expect not to be done more than twice in the 10 years that you own it. So if you're expecting to overhaul an engine twice, then you're okay. But obviously most of you aren't purchasing a tractor with the intent you're going to have to overhaul it twice. It's probably gone before it's getting that second overhaul because something's wrong with it. There are a couple of items that don't need to be capital, or that you need to look at with this as well. They're called betterments, restorations, and adaptations. If you make the product better, more efficient, the biggest example I can use in a room like this is I had somebody who put different roller chains on a corn head. They put snap rollers on this corn head. And they told us it makes it it works better, it advances the technology of the corn head. In the eyes of the IRS, that's a betterment. This cost them about $20,000 to do. That needs to be capitalized. It's not a repair. A restoration is something that, the best example probably going back to a tractor type of a thing, it doesn't work. It's not, the engine's blown, their tires are shot, you're restoring it back to original condition or like new condition. That's considered a restoration in their eyes. That needs to be capitalized. The other one is an adaptation. And this is where you're taking something and making it different. You're changing it so that its use is different. That also needs to be capitalized. So I guess the biggest thing out of this that I wish I would like you to take from this would be that when and especially for our clients, what we're doing is we're looking at the repairs pretty closely. We're going through, and a lot of times it's that kind of that $5,000 number, depending on the size of the operation. If I got a guy who's got 1 quarter and 3 tractors and he spent, let's just say his gross receipts were $100,000 and he spent 20 on repairing a piece of equipment, we're probably having a conversation. If he spent even 5 on a piece of equipment, we're probably having a conversation. Well, was this an overhaul? What was this? Maybe we should be looking at capitalizing it. This is something that we don't expect the IRS to be looking at for a couple of years, just because we don't think they're going to understand the rules very well for the first couple of years either. But it is something that we're reviewing, that we're looking at. We also are putting together sample capitalization policies to give our clients to look at that says anything over $5,000 we're going to capitalize, anything under $5,000 we're not. Now this doesn't protect us completely from the audit from the IRS, but it does say, well, we have this policy in place, this is what we were looking at, this is what we feel is a capitalizable item. But you're probably going to be getting questioned more on that. Yeah?
Didn't I get a letter that said we're supposed to have a capitalization policy in our file by the end of the year? Did I get that from my accountant? Does that sound right?
You might have. The IRS is saying you should. What we're doing is, with our tax planning, we're working on those conversations, and we'll backdate it, probably, is what we're probably looking at doing, so that you had it. Because what's kind of odd about the way the law is written is the capitalization policy, in the wording of the law, it doesn't have to be written. We're going to a written one just for the fact that we want documentation. And it'll say effective January 1st, 2014, something along that lines. But you probably did. So, like I said, that's something that we're looking at. This is one of the major hot button items right now in the tax world with the accounting and tax professionals. Just because of the fact that we're concerned that it's going to open some stuff up to the IRS to look at. Because before, we were never really that concerned, because with the 179 limits where they were at, if we could retroactively go back to section 179, and so it really was kind of a moot point. Depending on what section 179 does and some of those types of items, that's one of our concerns as well. So I guess the biggest thing to take from it is talk to your preparer, talk to your accountant, and be discussing these items, because it still is kind of an item by item basis. I mean, there's some fun rules with some of it, and there are some advantages to it. I didn't put it in here, but if you have a piece of property like a building or something like that, let's say the roof gets shelled out on a building. Well, if you've still got life left on it, you can write that off in the year that you put the new one on. You can take some of the cost to take it off and write that off in the year you put the new one on. So there are some taxpayer advantages to it. Like I said, the biggest thing I would say out of it is probably just be talking to your accountant about it, because it is an issue that's going to be ongoing. The final conversation of the day, depreciation. As of today, the depreciation limit is $25,000, phased out at $200,000 of purchases. It's dollar for dollar on the $200,000, so if you spend over $225,000, you've lost your section 179, it's gone. There is no bonus depreciation as of right now. The experts, if you will, are all over the place on it. I've heard anywhere from $150,000 to $500,000, bonus it back at 50%, bonus at 35%, no bonus. I was at a class 2 weeks ago where Andy Needle spoke. He's the farm tax expert in the area. He's from up in New Ulm, Minnesota. He thinks it's going to be $500,000, and he thinks the bonus is going to go to 35%. He actually thinks the bonus is going to be the bargaining chip. There was a bill that went through the House, passed at $500,000 and 50% bonus this summer, and that was actually a permanent extension. But nothing further has come from that. There was a bill that left the Senate committee that was $500,000, and I can't remember what bonus was out of that one. It went through the Senate committee and passed the Senate committee at those items and has gone no further. We were told that after the midterm election, they thought they would take it up. However, obviously, we're past the midterm election and they still haven't done anything. My best advice at this point is we're doing some plans both ways. Andy had said that he works for Clifton Larson Allen, or is a principal with Clifton Larson Allen, and they're tax planning at $500,000 right now. I feel that's a little dangerous. I'm somewhat more cautious. I'm tax planning right now with 2 different scenarios or 3 different scenarios. I'm going through with if it's at 25, if it goes to 500, if there's something in between, what our plans are. Because I got some people who got some big numbers and they can't count on losing $500,000 worth of depreciation because Congress didn't act. What we think is going to happen, what we're concerned is going to happen, is they're going to do what they did a couple years ago and pass it on January 3rd, retroactively back to all of 14. And in fact, in some cases, I'm hoping that if they do that, they at least pass it then. We'd like to see a law now, but we don't foresee that happening anytime in the near future. They're too busy on the Excel pipeline right now. So that's the best I can tell you on depreciation. Following that, I did put a couple of other items in here just for people to be aware of because of the fact that we're losing or possibly losing the 179. Leases, I'm starting to hear commercials already from dealerships talking about leasing instead of buying. Leases are 100% deductible when you make the payment. However, the lease has to be written correctly in order to do it. And I'm not saying that the dealerships don't know how to write these leases, but I'm just cautioning you, be careful with the leases because if they're not written correctly, they become a capital lease and it's just like you bought it. And here's probably the 3 or 4 major items that indicate a lease purchase agreement, which is a capital lease. A portion of the payments applied to equity. Titles transferred after so many payments. The big one is the bargain purchase option, or a portion of the payments are designated as interest. The bargain purchase option is the big one. If you've got a 5-year lease on a tractor and you can buy it out for $1, that's a capital lease. And even if it's less than fair market value, it's probably considered a capital lease. And you need to make sure, if you're going in that route, you need to make sure that it's written in a way that can help you. So, I guess the biggest thing on this is I just want people to be aware that the dealerships are starting to push them just because they don't know what this 179 law is going to do, and they're pushing on their year-end sales. So if you do enter into a lease, make sure that it actually is a true lease, an operating lease, not a capital lease. One other item that I wanted to make sure I mentioned, prepaid farm supplies, prepaid expenses. Because of the 179 concerns, we're also looking at people ramping up some of their prepaid expenses this year. It's not a problem to do it. A couple of big items that we need to make sure when we're doing it, it's a purchase, not a deposit. You can't just go in and give CHS $350,000 and say we'll deal with what it's supposed to be later. It has to be for a specific amount of fertilizer, a specific amount of chemical, a specific amount of seed. It must be for a business purpose, and their idea, and this is what's kind of goofy with the IRS, is the last 2 actually, the business purpose and does not result in material distortion of income. The business purpose one is actually pretty easy. I wanted to secure my fertilizer, I wanted to secure a price, I got a 10% discount, some of those types of items. Does not result in material distortion of income. That's basically what a prepaid expense is. You're trying to distort your income. That's the whole purpose of it. So it's kind of an odd way it's worded, but the biggest one though is probably it's limited to 50% of the deductible farming expenses over a 3-year average, excluding the prepaid expenses. So you have to look at what your expenses were for farming for the prior 3 years and average over the prior 3 years, and it's not supposed to exclude that. So, or exceed that, excuse me. So that's where, if we are looking at possibly doing a few extra prepaids this year, make sure we don't breach that rule when you're looking at it. So, Other things to mention with this, you can prepay your rent and your insurance as long as it's not beyond 12 months. You can also prepay, or sorry, you cannot prepay your interest. You can pay your accrued interest up to the end of the year. You can't pay next year's interest. So, this is the final slide I've got, I believe, just kind of a rough capital gains tax rates. I know people are always looking at those. They've actually stayed the same this year as they were last year. If you're in the 15% tax bracket, which is for a married filing jointly person, is up to 72,500, almost 75,000, somewhere in there. That first 75,000-ish is tax-free. The next bracket goes to the top of the 39.6% bracket, which this year in 2014 for married filing jointly, that is 457,000 is the top of the 30, or that puts you into the 39.6% tax bracket. That's at 15%. If you get into that, over that 457,000, you're at 20%. And the one other thing I will say with that is, I don't have it listed here, but, and I'm assuming most of you are actively farming, so it may not matter. But if you're not, if it's a non-active asset, for instance, if you quit farming more than 3 years ago and you're selling land, there's an additional 3.8% that gets added because it's considered passive activity at that point. But I'm assuming that that's probably not an issue. And that's, like I said, that's my presentation. Are there any questions? Oh, yeah, sorry, go ahead.
I got a question. That word you use quite a bit, capitalize. What exactly does that word mean?
Well, what that means is it needs to go on a depreciation schedule. So for instance, when you buy a tractor, we use the term capitalize because you're going to, that's the terminology that the IRS uses in the accounting industry they use. You're going to put it on your depreciation schedule is what it means. It becomes what they call a capital asset.
I guess I was more questioning the repair side of things.
It's the same concept. Let's say you've got a tractor that you had it for 2.5 years, the engine blows up on you, you spend 20 grand to replace it, to overhaul the engine. It probably needs to be capitalized and put on the depreciation schedule. It needs to go on the depreciation schedule. The difference is you now have to write that off over 7 years instead of in the year you wrote the check. It becomes just like you bought another tractor. And that's where our concern is with this, is they're looking at possibly making us put some items in. The net effect after 7 years is the same because you just change how you're depreciating it. However, instead of being able to write the whole thing off in a year of the expense, we now have to take it over 7. So that's one of our concerns out of the repair regs rules, is that we're going to have to pull back some of these expenses that have been normally repairs and put them on a depreciation schedule now. The other side of that is, in looking at that, if the 179 limit goes back to 500,000, it probably doesn't affect people nearly as much. I mean, it affects our bigger operators, obviously, because they're spending a pretty good chunk of money in the year. But a lot of our smaller operators, what I'll call our smaller, regular-sized operators, it's probably not going to affect them unless they have a big year of capital purchases, because we can still take the 179 on it if we've got room to take it. Yeah.
So what do you suggest doing then, like, I quit teaching to farm, my husband, so we've been in this agri-plan for, 30, 40 years. Now, if we have another employee, you're saying opt out of agri-plan, what would be the best fit?
Unfortunately, now, are you offering it to the other employee?
So far, he's paying for his own health insurance, so is that just okay if he does?
It is. The bigger issue is the unreimbursed medical expenses, because that's actually, for a lot of people, that's where the big dollars come in. I mean, you get the health insurance premiums, but the biggest issue is you can't discriminate for those out-of-pocket medical expenses either. And as soon as you do that, you're in violation of the Affordable Care Act. And so we've been advising anybody who's got more than one employee to opt out of the ag, to get rid of the agri plan. Now, you still get to deduct your self-employed health insurance. It's in a different spot, and it's not against the self-employed, the Social Security tax. Because that's one of the big sellers on it, is you get to deduct your self-employed health insurance against your Social Security tax. Instead of, whereas for most people, if they're self-employed, they have to go put it on the front of their return. It's what they call an above the line deduction on their return. And so you don't save the 15.3% self-employment tax on that, whatever the premiums are. You still get to deduct it, just not to the extent you did before. But unfortunately, I will tell you that most of the national experts are saying if you've got more than one employee, you really have no options. Because, like I said, the penalty is $100 a day per employee. So it can run up, I mean, you know, for one employee, it's $36,500 for the year. So it's one of those deals that nobody read it. For lack of a better way to put it, nobody read the law before they put it in place and didn't see how it affected people for certain items. They just all went, oh great, everybody's gonna have health insurance, it's the best thing in the world, and passed it. So once they get into it, they've got a few of these things that we've got to start working through. But the best answer I can give you is we probably need to stop the plan. It's not worth the risk of the penalty. So, yeah.
Okay, with that, biz plan, we have one full-time employee, we have a couple of seasonal workers. The part-time guys included this too?
I don't believe so. The seasonal workers, because the way the plan is written, you have to meet certain requirements to be eligible. And so your full-time person probably would be eligible, and maybe you're providing it to them, I don't know. But the seasonal ones typically would be exempted because they don't work the enough hours, primarily would be the one. Because the plan's written, you've got to work so many hours before you're eligible. Most of them are written, and I can't tell you what the exact number is, but most seasonal employees would not qualify for the plan. So as long as they don't qualify for the plan, you're okay. But if you've got one full-time person and you're not offering it to them, that's where the penalty's going in. So, yeah.
On the 179 deduction, what, you talked about the bonus, what is that?
They have, since basically 2001, they have had what's called bonus depreciation. Anything new that you purchase, you could automatically, and the percentages vary. Last year it was 50%. Anything new that was purchased, you could write off 50% immediately. And this is actually what Andy Beeble thinks is going to be the bargaining chip in Congress when they finally get around to passing this. The reason being the real big boys, the Cargills, the UPSs, the FedEx, they don't care about the $500,000 write-off because they spend millions a year. Because the way the $500,000 write-off works right now is it's $500,000. Once you've spent $2 million on equipment, you start losing it dollar for dollar. Kind of like I was saying with the $200,000, you start losing it dollar for dollar. Well, with the $500,000, the phase out is $2 million, and you lose it at $2.5 million. Well, these places are spending millions on new equipment every year. So what's actually good, better for them is the 50% bonus, because they can write 50% of it off right away, and it's a bigger chunk of money. So that's where the bargaining chip is. But anything new that you purchase, a new vehicle, a new tractor, as long as it's brand new, first, well, I should qualify that, not necessarily brand new. First placed in service with you, first titled with you. Where we sometimes see a gray area on that, or where we may see it is, I know both Scott's and C&B have state lease tractors. Well, they're never actually titled out, so when they sell those state lease tractors with a few hours on them, they're actually considered new. And that's where that comes in. If you buy a new tractor for $100,000, you can automatically write off $50,000, and that does not affect your Section 179 write-off. So that's where, I guess for lack of a better way to put it, that's where they think the bargaining chip in Congress is going to be, because that hit to the budget is way bigger than what the Section 179 hit is. So
right now,
there is no bonus right now
for anybody.
for anything. That's correct. They have nothing. So they, like I said, I've heard anywhere from none, 35%, 50%. It kind of goes back and forth. There was a while, a few years ago, where it was 100%. And I should tell you also, buildings qualified, farm machine sheds qualified. We had a lot of people writing off machine sheds using that bonus because farm machine sheds are considered 20-year property, and that qualified for the bonus. Grain bins are 7-year property, tractors are 7-year property, livestock is 5-year property. The 7 and under are all actually, and then single purpose ag barns, hog barns, cattle barns, if that's all it's used for is cattle, a granary type of a thing, those are all 10-year property. Everything 10 and under was eligible for section 179. And then anything that was new on any of those up to 20-year property was eligible for the bonus write-off.
So are they gonna play with that bonus as far as possibly just giving the bonus and not the 179?
We don't think that's gonna happen. All the experts seem to think that the 179 is gonna go back to the 500,000. And then the bonus is where they're gonna play, whether it's 50%, 35%. And for our area, we'd rather have the 500,000 179 than the bonus. Because a lot of people aren't buying brand new machinery anymore. A few years ago we were, but we're not as much now. And so that's where we're hoping for the 500,000 just because that benefits our clients much more than the bonus does.
So you're thinking there's a pretty decent probability that that's gonna happen?
I knew somebody was
What's the
gonna ask.
over-under on this deal, or?
Like I said, the national experts are all saying better than not chance for bet. I hate to use that terminology, but I can't really put a percentage on it. If I were to guess, I'd say they're thinking somewhere between 80 and 90% that it's going to happen. Like I said, Clifton Larson, which is a very large accounting firm in Minnesota, and then they've got a lot of offices in Washington and up in the northwest, excuse me. They're tax planning with the 500,000 with the expectation that it's coming back. I tend to be a touch more cautious, which is why I'm doing 2 different ones. A couple of mine, I've warned them, we're planning on it, but we've also got a just-in-case scenario put together for checks to be written on December 31st, just in case it doesn't get passed. That's the cautious side of my nature, because I do not want to be the one that said, we planned on $500,000 of depreciation, we lost it, you now owe another $150,000. I'm not having that conversation, which is why I'm being cautious that way. It would solve everybody's problems if Congress could do something, but.
But if you're ultra cautious, you'd be worried about capitalizing everything over $500 too, right?
I'm a little bit more liberal with that one. Because that one I can, my repairs expense typically, I mean on my real big ones, we're talking maybe 100,000 of repairs, which not all of that would be considered. We're looking at more stuff over 500, or more over 5,000. If it's over 5,000, we're probably talking about what it was. And even then, we may not be capitalizing. It's going to be the big things. It's going to be the engine overhauls, overhauling the combine, overhauling the tractor, overhauling the semi-engine, something like that. And even then, under those rules, we've probably got some options to say, well, we expected to do it a couple of times type of a deal. But I'm not as cautious on that one, just because of I think the $500,000 is a dumb number, so. Yeah.
So the 200,000 is for new tractors, you can still use that? Does it pull sheds too?
Well, actually, the 200,000 that I was talking about was, you can write off 25,000 right now.
What's the 200?
If you spend over 200,000, you start losing that 25 dollar for dollar. So once you hit 225, you've lost all of it. So the 25 is doing no one any good. Like I said, I can't give you a probability, unfortunately. We're expecting it to go back to 500, and the biggest reason that I expected, and that we've kind of talked about in our office that we expected, is both the House and the Senate have passed some sort of bill or sent a bill out of committee that had support at 500,000. But my best guess is they're gonna do it end of December, first part of January, and retroactively do it. There are currently 55 extender laws that they need to pass before the end of the year, affecting taxes, which is also going to affect everybody's filing, because until they pass those, the IRS can't finish the tax forms, which is going to push back filing. A couple of years ago, 2 years ago, this same thing happened. That was when all the farmers were allowed to file late, because of the fact that Congress dragged their feet so long, the IRS couldn't get the forms done, and we couldn't file in time. So. Any other questions? Well, if not, thank you very much. I appreciate being able to talk to you guys. And like I said, if you have anything else, feel free to, I'm going to stick around for a while, so feel free to catch me or do whatever. So, thank you.
All right, thanks, Jonathan. Give us about 30 seconds. We're going to get the pizzas ready. You guys can come out and grab a piece of pizza, and then